Hey, it's Eric Powell with the Future Mill. I remember when I was 19 years old, I went and I sat down at my CPA's office. At the time, I was a firefighter and a small business owner, and I had zero clue about investing. They handed me a clipboard and they said, answer these questions. Now, when they said answer these questions, I had no clue what they were planning on doing, but they wanted me to answer a questionnaire. I looked through it. I had no clue exactly what I was doing, but it was actually a risk tolerance questionnaire. Now, when I got into the meeting with the CPA, they said, we want to open up a traditional IRA for you, and you should do this because you're making good money and you need to start putting money away. Now, that was a great idea, but the problem was nobody told me how to answer this questionnaire. I was looking at this and it made no sense to me. It looked like foreign language. So what I want to do is I want to go over a sample risk tolerance questionnaire with you and teach you exactly what they are looking for or what an advisor is looking for when it comes to this. So let's take a look. This is a Morningstar risk tolerance questionnaire. The first question is, what is your current age? It's pretty cut and dry. What is your current age? But what they are looking for when it comes to this question is how close are you to retirement? If you are 60 years old, you're probably a lot closer to retirement. You're closer to getting Social Security. But then if you're 20 years old, you're a long ways out from retirement for the average person. That's something they're wanting to gauge is what is your age. The next question is, when do you expect to start drawing income? What they are talking about is when you are investing and you are saving up your money, when do you actually want to start getting money off of the investments? When you retire, you're going to have income coming in. So when do you plan to start pulling money from those investments? Not for at least 20 years and 10 to 20 years, 5 to 10 years. Multiple different answers there, but that's what they're looking for. What is your goal for this investment? To grow aggressively, significantly, moderately, with caution, or avoid losing money? This one tripped me up when I was 19 years old. I had no clue what it was asking for. I said, well, grow aggressively? I don't want anybody to lose my money. That's generally not what it means when it comes to a retirement portfolio. An aggressive portfolio is oftentimes, majority of the time, in stocks only or very little bonds. So what ends up happening is your ultimate goal is long-term growth, though there's going to be more ups and downs than if you had more bonds in a portfolio. Now, the more you get down to that avoid losing money section or with caution, the more bonds you are going to have. Now, bonds are a bit like a mortgage, though you are the bank. You are loaning corporations or the US government and other entities money, and they are paying you interest. The thing is that there's not as much volatility oftentimes in a bond or ups and downs with a bond, but the return isn't as high either. It's all trying to find out what your emotions are, what your comfort level is, because the more aggressive you want to be, the more risk you do have to take, and knowing that there are going to be more ups and downs in the market. Assuming normal market conditions, what would you expect from this investment over time to generally keep pace with the stock market? This means putting your money in something like an S&P 500 index or trying to keep pace with that S&P 500 index. That's one of the major indexes. It has 500 of the largest US companies in that. And so that's oftentimes something that is compared to when it comes to investing. Now, you have others slightly trailing the stock market but making a good profit. As you go down the list here, the lower you get to where you actually, the last answer is have a high degree of stability but make small profits, you have more bonds in the portfolio. So if you're looking at this, all of these answers, what you have to realize is that the answers on the very bottom are oftentimes less aggressive and have a lot more bonds in the portfolio. You're not going to see as high of returns, but you're not going to see as much up and down in the market as well. For the next question, suppose the stock market performs unusually poorly over the next decade. What would you expect from this investment? Now, this is taking a look back at something like 2000 to 2010. The market actually didn't have much of a return because in 2008, we had the global market crisis. In 2001, we had the World Trade Center attack. And in 2000, we had the dot-com bubble. All those combined, the 2000 to 2010 decade was pretty flat. It didn't look real good. So they're asking a question to make sure that you're comfortable with having not much of a return on that decade if that were to happen again. The first one is to lose money. You would expect to lose money on that, or it goes all the way down to be little affected by what happens in the stock market. So if the stock market is way down, that means that you don't want to lose much money. The problem here is you do need to risk money to make money and to keep up with inflation. So just remember that. Next question, which of these statements would best describe your attitudes about the next 3 years' performance of this investment? I don't mind if I lose money. I can tolerate a loss. I can tolerate a small loss. All of these are, again, weighing in on what is your comfort level when it comes to things. The reality of it is that there are going to be ups and downs in the stock market. It's happened historically, but it has always rebounded. So if you get in the market and you stay in with a diversified portfolio, you have to be comfortable with knowing that sometimes you're going to open up your statement or your investment statement, and you're going to realize that your money may be down a little bit. It's going to happen, though you have to stay in. You have to have that long-term view when it comes to investing. Next question, which of these statements would best describe your attitude about the next 3 months' performance of this investment? Who cares? One calendar month means nothing. I wouldn't worry about losses in that time frame. If I suffered a loss of greater than 10%, I'd get concerned. We hit something like that, suffering a loss of greater than 10%, you get concerned. This is where you're wanting to go a lot less risky or a lot less aggressive in the stock market, and you're going to incorporate a lot more bonds if you can't handle those ups and downs. The problem I see is two things. I see people that are young that don't want to take much risk at all, and you are costing yourself a lot of money. Because long term, the ultimate goal is you're not even close to retirement. You want to get those higher returns. So you need to have more of an aggressive portfolio. Now, this is more education. It's not financial advice. It all depends on your specific scenario. But this is the overall average of what I see. Now, when it comes to another side of this, what I see is young people that get super aggressive. But then what ends up happening is they forget to change their risk tolerance, because as their time goes and they build their wealth, they actually become less aggressive, though their portfolio stays aggressive. Now, why I say that is because what they have done is they have built some wealth. And let's just say you had $1 million. Well, with COVID happening, the market went down, let's say roughly 35%. If you have $1 million, you now have $650,000 in your account. A lot of people, once they get to that amount of wealth, they can't take those kind of downturns and stomach them, and they could make a bad decision. The idea with this is for an advisor to learn about you, learn your comfort level, and to continue to reassess this. This should always be reassessed. I would say on an annual basis is a good idea to find out what your comfort level is and has anything changed when it comes to your investing emotional comfort. So that's a quick risk tolerance questionnaire. If you have not yet, please like and subscribe. Feel free to share this because we love to educate as many people as we can when it comes to finance and investing. If you have not yet, also go to thefuturemill.com, click get started. You can create a portfolio for free. You can do some do-it-yourself planning. You'll also have the opportunity to go through a risk tolerance questionnaire to find out what kind of portfolio we recommend. If you have any questions, go to the About section. Feel free to shoot us an email. Thank you so much for watching.